Okay, I think we'll get started, folks. Thanks very much for coming out tonight. My name is Thomas Cook. I'm going to be leading the workshop for us this evening. A couple of the ground rules, first of all. If you have any cell phones or pagers, if you could turn them off, put them on vibrate, whatever, so they don't interrupt the group. Everybody goes for their side pockets. And the other rule is that you have to ask lots of questions. Okay, so there's no such thing as a dumb question. If you're thinking it, probably someone else is as well. And we don't say wait until the end. We've been doing these workshops since when? 1902 now, right? About 12 years, actually. And we find it makes it more interesting, more interactive. If you have a question, just put your hand up and we'll try and answer that question right away for you. Okay, we'll start off by giving you a little background of where we're coming from in terms of experience and knowledge. I've been in the real estate industry since 1980. I started with LePage back then, and I switched to Remax Hallmark in 1983. And I've been with that same company ever since. And besides helping literally thousands of people to buy and sell during that time, I've done a number of other real estate related things as well. For example, for several years in the 80s, I had my own property management company. And at times, I was managing up to 350 single-family homes, duplexes, triplexes, condos, small 4- and 8-unit buildings, mainly for investors, but oftentimes for people who were being posted out of the city on a job transfer and wanted to maintain their residence here. Now, that's given us some great insights into tenant-related issues, knowing the Tenant Protection Act, knowing how to design a really good rental application and a really good lease. And we find that helps our clients today who might be interested in buying something that has a rental component to it. Maybe the traditional basement apartment and the owner lives upstairs, or some other split where there's more than one kitchen involved in that particular home. I've also renovated a number of homes, built one from scratch in Riverdale several years ago, and my wife Sally and I just built a cottage up in the Kawarthas about 1.5 years ago. And that's certainly given us some great insights into dealing with contractors, going to City Hall, getting building permits, even on occasion going to the Committee of Adjustment or the OMB, the Ontario Municipal Board, if we couldn't get a permit automatically and had to apply for a variance along the way. We find that helps our clients today who might be interested in buying something that needs some renovations to it, some fix-up work that's required. And for example, one common question that we get, whether it's a house buyer or a condo buyer, is could we take out that wall between the kitchen and the dining room? We'd like to have a more open concept there. Is that a structural wall? And if it is, how do we open it up and support it so we don't damage the integrity of the entire structure while we're doing that? And we can certainly answer those kinds of questions and many, many more besides. Now, I also have, I used to have my own mortgage company for several years. In fact, that's how I met my wife and partner, Sally. Now, Sally will be here in about an hour's time, but since she's not here yet, I'll let you in on the big secret, and that is that's how we met. She picked me up at one of those mortgage functions one night, and the rest is history. Right? Well, that's my story. Hers is slightly different than that one. Mine sounds a lot better, though. Anyway, that's given us some great insights into mortgage financing. So knowing how to package the application so we get the best rate and the best terms for our clients along the way. So tonight we're going to be covering a myriad of topics. Sally's going to be here to talk about the buyer consultation, what that's all about, why it's so important, when in the process you would have it, and so on. We're going to have George back after the break to talk about the mortgage consultation. So he'll be talking about short-term versus long-term mortgages, fixed rate versus variable, pluses and minuses of those, using RRSPs towards your down payment, and he'll be able to answer the many questions that people typically have around that very important part of the process, which is the mortgage financing side. We're also going to watch a short video from Carson Dunlop and Associates. Now, they're the premier home inspection firm in the city. They've been around now since 1978, and the last count I saw, they've inspected over 75,000 homes across the GTA in that period of time. And then finally, I'm going to be covering a complete overview of the home buying process from start to finish. So our goal and vision for you is by the time we leave here at roughly 10 p.m. tonight, you'll have a very, very clear idea of what it takes to go from today to the day that you get your keys. Now, for some of you, that might be 2 weeks from now. Others, 2 months. Others, 2 years. Really doesn't matter. Take what we're going to be telling you tonight and contract it or expand it to fit your own personal schedule and so on. So we're going to start off with some definitions. So if I can get you to open up your books to page 6, I believe it is. And please feel free to take lots of notes here. These books are yours to take home with you. And we expect you to keep them by your bedside at all times for a good nighttime reading, right? So market value. So market value is defined as the highest price that a property would sell for in an open market, while allowing for a reasonable time to find a willing purchaser, and most importantly, a purchaser who has been advised of what comparable homes have been selling for in the immediate area. Now, by the way, this evening, what we're going to be doing is telling you how our team works. Of course, we'd love to work with every single one of you. Sometimes that's not possible, though. You might be buying in Burlington or Keswick, some area which we don't service. So take what we're going to be telling you tonight and use it as a benchmark or a guideline when you're out there looking for an agent to represent you. So the first question that always pops up when someone finds a home they really like is, what should we be paying for this home? What is it really worth, right? Well, what we're going to do is go back to our computer, pull off all the comparable sales on that particular street or neighborhood or that specific condominium building. And we're going to pull off sales ideally going back only 60 to 120 days. Because the market is continually changing, down or up. So the sales that we want to pull off, we want it to be most representative of the market that we're in at this point in time. So let's say we were looking at a condo over at 222 the Esplanade. And let's say it's a 814 square foot, 2-bedroom on the 10th floor facing south with a parking space. Well, in an ideal world, the one right below it on the 9th floor or the one right above it on the 11th floor would have sold last week, right? And we know because it's on the column like that, it's the exact same square footage. Maybe there's a few minor interior changes, but that's going to give us a very good idea of what the value is. But let's say the one that sold most recently was on the 2nd floor facing north into the courtyard, because that particular building is shaped like a U. This is north. And there's another building at the top of the courtyard. So you can appreciate on the 2nd floor, you don't have as much of a view, and you don't get as much sunlight, right, as that southern view on the southern facing one on the 10th floor. So what is that difference worth? Well, appraising real estate is not an exact science. It's not like going to Canadian Tire and picking up a widget and comparing that same widget to the one that you could buy at Walmart, let's say, right? It's not going to be that accurate and that simple and straightforward. So what we do is we try to determine the value within a range of X to Y. So let's say that 2nd floor unit, which sold in mid-December, sold for, let's say it was $300,000. Right? By the way, it didn't have a parking space. So the difference in value between that 2nd floor facing north into the courtyard versus the 10th floor south is probably at least a $5,000 to $10,000 difference in value. So that brings us up to $305,000 to $310,000 for the one that we're looking at. Then remember, it didn't have a parking space. So in that particular building, a parking space is worth about $15,000. So that brings us up to $320,000 to $325,000, right? But now the 2nd floor unit had brand new hardwood floors, and the 10th floor unit had builder's carpet, which by now is about 15 plus years old, showing some wear and so on. So that's a $5,000 upgrade right there, but the other one had it. So now we're going to subtract it off, and we're back down to about $315,000 to $320,000, right, for our range of value. Now we go back to November and find another sale, and we go back to October and find another sale, and the average of all of those should be the range of value that we're looking at. So this whole process is called a comparative market analysis, or CMA. So I want you to remember that term for this evening because we're going to refer back to it many, many times. So CMA, or comparative market analysis. Now, there's two kinds of mortgages that the banks will provide to you. The first one is a conventional mortgage, and that's a mortgage that does not exceed 80% of the purchase price of the property. And a high ratio mortgage is any mortgage that goes from 80% up to 95% of the purchase price of the property. Now, in the old days, we used to have 100% financing. That's been taken back about 1.5 years ago. So now our maximum we can do is 95%. So any high ratio mortgage must be insured by either one of two companies, CMHC, which is Canada Mortgage and Housing Corporation, or Genworth Capital. Now the interesting thing is that insurance benefits the bank, but you get to pay the premium for it. Okay, so what I mean by that is, let's say someone doesn't make their mortgage payments. Well, the bank would step in and take that property back. Now everybody's heard the term foreclosure, right? It's been pretty common in the news lately, referring to the American situation. Well, in Canada we call it power of sale. Okay, it's exactly the same thing. They have foreclosure, we have power of sale, right? So the bank would take it back under power of sale. They would sell the property, and let's say they came up $7,000 short. Well, they're covered. They would simply go to CMHC, present their invoice, and walk away with a check for $7,000 and break even in that transaction. So that's a good thing, because the banks wouldn't be willing to lend up to 95% financing if they didn't have that insurance in place. So you might want to write down in your books now what the CMHC fees are for different loan-to-value ratios. So between 80 and 85% financing, the fee is 1.75% of the mortgage amount. Now that's a one-time fee, payable when you take possession of the property. And I'd say 100% of the time, the people just add that fee onto their mortgage. So you don't have to come up with cash out of your pocket for this. They simply add it on and you pay it off over time. Now between 85 and 90%, the fee goes to 2% of the mortgage amount. And then between 90 and 95% financing, where the banks feel the risk is the greatest, the fee jumps to 2.75%. Okay? Now, with any high ratio mortgage, you also have two options. Number one is you could choose to pay what's called the posted rate. That's the rate that you would see perhaps on a bank branch wall, or you would perhaps see it in the Toronto Star. They have a mortgage monitor every Sunday or Monday in the business section. And posted rate was there. Now, John, what's the 5-year posted rate right now?
Right now it's 5.49%.
5.49%. So if you chose to take the posted rate, the bank on closing would give you a check in your hand equal to 4% of the mortgage amount. And that's called cashback. Okay? So you might say, well, why would you do that? Well, let's say, for example, a $300,000 mortgage, that's a $12,000 check. It's quite a lot of money, right? Well, one of the reasons is you might not have enough money saved for your closing costs. So you could use it to pay those. Or let's say you fell in love with this particular home. The home inspector came down off the roof, said, you know what, you got to replace that roof the day you close because it's really bad. That's a $9,000 cost, which you didn't have the money for, and the seller wasn't willing to compromise, because sometimes we can negotiate that. You could use that for that purpose as well. Or you could take a nice cruise through the Caribbean. Okay, the money is yours to do with absolutely whatever you want. So you have those possible choices there. Now, there's two ratios that the banks use to calculate how much mortgage they're willing to lend you. And these actually are so important, we're going to be doing these for you, these calculations twice. Once in the buyer consultation and once again in the mortgage consultation. So the first one is the GDS, or gross debt service ratio. And that takes into consideration the annual payment for mortgage principal, interest, realty taxes, and a flat $900 estimate for heating. And it divides that number by the gross annual income of the borrower. Now notice I said gross income, not net, right? Everyone's net is different. Everyone has different deductions at source. So to even the playing field here, they take the gross income into consideration. So the GDS should not exceed 32%. And by the way, before we let you go home tonight, there's a 10-page written test with all these numbers on it, right? Got to pass that test. Now the other side of it is the TDS, or total debt service ratio. So that takes into consideration all your other debts. So it starts off with taking the same annual payments for mortgage principal, interest, realty taxes, and so on, plus annual payments for any lines of credit, credit cards, student loans, car loans, etc. And then again divides by the gross annual income of the borrower. Now, if two people are buying, you're going to combine your gross incomes to work out what these ratios might be. So the TDS should not exceed 40%. So 32 and 40 are the magic numbers there. Now, many of you have heard of a 6-month mortgage or a 1-year mortgage or a 5-year mortgage. Well, that's the term of the mortgage, the length of time that the interest rate is fixed or guaranteed for. Amortization, on the other hand, is defined as the number of years that it would take to pay your mortgage off right to zero if the interest rate was constant all the way through. Now, in Canada, that has traditionally been 25 years. So if you started out today with a $200,000 mortgage at, let's say, that 5.4%, at the end of that 5-year term, you would have to reevaluate and start your mortgage over again with a different interest rate and so on. Okay. Now in Canada, we also used to have 30, 35, and 40-year amortizations. And again, about a year and a half ago, we lost the 40-year amortization option. So now we're down to 30, 25, 30, and 35. And by the way, you have that other choice too, is to take the discounted rate on that mortgage instead of having the posted rate. John, what's the discounted 5-year rate?
Right now it's 3.89%.
3.89%, which is a fabulous difference, right? So of course you wouldn't get the cash back in that situation, but you would get a much lower interest rate and a much lower payment on that mortgage.
What was that again?
Discounted rate. Okay. So often, and that's a negotiable. So we've told you you can get that 3.89%. If some lender tells you more, come back to us and we'll steer you the right way, right? Because certainly it's negotiable anywhere down from that posted rate of the 5.49. Okay. Now, just to give you some relevance here, if you were buying a condo in downtown Tokyo, they've been used to have 99-year amortizations on their mortgages, right? Because prices were so high, they felt to make the place affordable, they had to stretch the payments out for 99 years, right? So over here, where oftentimes you inherit a property from your parents and it's all mortgage free, over there you inherit the mortgage. Such a deal, right? So we're much better off here at our few choices. It's not too bad at all. So this is a sample of an amortization chart. And what it shows is for a $300,000 mortgage at 5.5%, and just for the first 60 months, the first 5 years, you can see we paid $77,000 in interest and just $32,000 in principal repayment. So every mortgage is heavily skewed towards interest that first 5 to 10 years unless you do something about it. So let's talk about some of the things that you can do. So first of all, the typical way of making mortgage payments has been to pay on a monthly basis. So let's say your payment was $1,000, you'd pay that on the first of each and every month 12 times during the year. And that's how they got that 25-year amortization. However, there are 3 other ways of making mortgage payments, but only 2 of them will shorten the amortization for you. So the first one is semi-monthly. So that means they take that monthly payment of $1,000, divide it in half, so $500, and you pay that on the 1st and on the 15th of the month. So 24 times during the year. Well, that does not shorten your amortization, so we do not recommend that one. The next one is accelerated biweekly. That means you make that same $500 payment, but you make it every 14 days. So every second Friday, every second Tuesday, whatever the case might be. And now, because there's 52 weeks in the year, you're actually making 26 payments annually instead of 24. So making those extra 2 payments every year shortens the amortization from 25 years down to 20.87. So that's a significant benefit. We encourage all our clients to at least go accelerated biweekly. Now, people often ask, well, if that's so good, what about weekly? Well, weekly would be $250 every single Friday, 52 times during the year. Well, it doesn't shorten it very much. It shortens it from 20.87 down to 20.5. So the significant benefit is to go accelerated biweekly. And be sure you stress to your bank, I want the one where I pay every 14 days. Because if you just throw out that term biweekly, the chances are 50-50 they'll put you into that 1st and 15th model, which is absolutely no benefit to you whatsoever. Now, maybe a quick show of hands. Who here has either spoken to someone over the phone or gone into a bank branch to find out how much mortgage they qualify for? Anybody? No? Okay. So the typical over the phone or over the internet method of determining that is okay as a very basic starting point, but it's really not very accurate, and there's so many variables that it's not something that you want to rely on. Unfortunately, even when you go into the branch directly and you're sitting across a desk from someone, it's oftentimes not much better. Why? Well, because oftentimes they only ask you some basic questions, such as, what's your income? They type in some numbers. What are your expenses? They type in a few more numbers. And up on the screen comes the amount that you theoretically qualify for. And I say theoretically because you haven't provided any proof of income or proof of down payment at this point in time, right? So if you're on the ball that day, you might say, well, could I have that in writing? So they'll press print, and out comes what they call a quick qualifier. Problem with the quick qualifier is all that fine print across the bottom of it. Because the fine print says, this quick qualifier is conditional upon you providing satisfactory to the bank proof of income. It's conditional upon providing satisfactory proof of down payment. It's conditional upon having a satisfactory credit bureau. And it's conditional upon having a satisfactory appraisal of the property. Now, obviously, you can't do the appraisal because you haven't even found a home yet. But you can and should do the other three up front. And there's some very, very important reasons why you want to do that ahead of time. So first of all, though, let me tell you what you need to provide. So proof of income. Most important there is a current employment letter. So that employment letter should state how much you're earning, how long you've been there, and what a fabulous employee you are. How to make it sound really good, right? Along with that, the next most important is your notice of assessment from Revenue Canada. And that's the paper that you get back with your big tax return, refund every springtime, right? Thirdly is a current pay stub. And finally is a copy of your T4. Now we get typically our T4s from our employers by the end of February every year, okay? But the notice of assessment and the employment letter are the two most important there. Now, proof of down payment. That could be a copy of a GIC or term deposit. Could be a copy of your RSP statements. Could be a printout of your bank account if the cash is sitting there. Or it could be a gift letter from Aunt Mary. Now, quite commonly, family members are participating in the purchase, so the banks have a standard gift letter that they would have Aunt Mary sign stating that she's giving you those funds. Right? And this is very important because we had a case recently where this gentleman was going to borrow some money from his sister. She'd agreed to give it to him. He went out, bought the condo, put the offer in. It was conditional on financing. A day before he was ready to sign the waivers to make it a firm transaction, the sister discovered that she couldn't get her funds out and had to turn him down. Now imagine if that had happened just a couple of weeks later, right? He would have been tied down to that property, but and committed to it without the funds to go ahead with it. So if you do have that kind of situation, you want to get that family member on paper so they know exactly what they're responsible for and committed to, okay? Now, credit bureau. Now, most people think their credit is excellent, but in fact, almost 40% of the time when we've done our credit bureaus for our clients, we've found that glitches and mistakes have occurred. We had a classic example one time. This gentleman had moved to Toronto from BC about 3 years prior to purchasing here. And when we did his credit bureau, we found there was an R9 on there from UBC. Now, R9 is the worst rating that you can get, right? R1 is what we should all aspire to. He said, well, I don't know what happened. I graduated, so I know I paid my tuition. Let me call them up and see what's going on. Well, it turned out that UBC was waiting for the day that he'd called, because what had happened was, while he was back on campus, he'd racked up a bunch of parking fines that when he moved east, he said, they won't bother me for those. I'm not going to bother paying them, right? Well, no, not the case, because UBC was a little smarter. They figured that as he matured in life, he would need credit badly enough to come back to them and pay it off, right? And that's exactly what happened. He gave them a Visa number over the phone. They faxed him a receipt saying it was paid. And he turned that into the bank with a letter of explanation of why that R9 was there. And you can appreciate that the banks have the ability to turn someone down for credit if they don't like that R9 explanation. So very, very important, get your ducks in a row. Provide that proof of income, proof of down payment, get the credit bureau done, and get in writing what we call a full mortgage pre-approval. And that full mortgage pre-approval should state the maximum amount of mortgage that you qualify for, the interest rate that's guaranteed, the length of time the interest rate is guaranteed for, and the phrase "no conditions." Very, very important. Right? Now, there was an unfortunate story in the Toronto Star a little while ago about this couple who went out to buy a home. They found the home of their dreams. They negotiated back and forth, got what they thought was a great price. And so they went into their bank the next day, and the banker only asked them the basic questions. What's your income? What are your debts? Up on the screen came the amount that they theoretically qualified for. Remember, theoretically, because they hadn't provided any proof of it at this point. And the number looked really good. The husband jumped up. He said, "That's fantastic. That's more than what we need. Thanks very much. See you later." So they went merrily off to their buyer agent and said, "Okay, everything's good. We've got our mortgage. Let's sign the waiver to make this a firm transaction." Well, a couple of problems here. Number one is the buyers were fairly naive. They didn't realize that they needed to provide proof of income, proof of down payment, and get the credit bureau done. They didn't realize, even more importantly, at that point in the transaction, they needed to get an unconditional commitment letter at this point in time, right? Not a pre-approval letter anymore. Now it's a commitment letter. And it should state the exact amount of mortgage that they're approved for. Again, the interest rate that's guaranteed. Now the CMHC approval number. And again, the phrase "no conditions." Right? Very, very important. Well, none of that occurred. In fact, I fault the buyer agent, because the buyer agent is there in the transaction to protect the interests of the buyer. So the buyer agent should have said, "Well, did you provide these things? And could I take a look at your commitment letter to make sure that you're protected in this situation?" So none of that occurred. Several weeks passed. Everything went on nonchalantly. Finally, about a week before closing, their lawyer called them up in a bit of a panic. "I haven't heard from your lender. What's going on?" "I don't know. We'll call." Called up the lender. He said, "Oh, no problem. Come in at 9 o'clock tomorrow morning. We'll get everything organized, put a rush on it, and we'll be fine." Well, as it turned out, part of the income that he'd quoted in that initial conversation was part-time income that he didn't declare to Revenue Canada. If you don't declare it, you cannot use it in your GDS TDS calculation. And in fact, many banks won't take part-time income into consideration under any circumstances. So they couldn't get the mortgage. They couldn't close on the property. They lost their $10,000 deposit that they'd given with the offer. And now they were going to be sued by the seller for non-performance. Because you can appreciate the seller's panicking. They've already bought something else, right? They can't afford to carry both places. They're going to sell this first one for as fast as they can, maybe for a little lower price, and go back after that initial buyer for any shortfalls and any expenses that they incur in the transaction. So very, very important, get your ducks in a row. Provide that proof of income, proof of down payment, get your credit bureau done, and get that full mortgage pre-approval in your hand.